There is a number on your phone right now that you probably think of as your credit score. When you sit down to get a mortgage, the loan officer pulls a different number. Both of them are real. Neither of them is wrong. They are simply not the same product. That gap is not a glitch, and it is not a secret. It is written down in public, in documents anyone can download. It just never gets explained before the day it starts costing money. So today we are going to do 3 things. We are going to find out exactly which number decides a mortgage. We are going to open the official table where that number turns into a price in percentage points published by Fannie Mae. And we are going to look at what actually changed in the last 12 months. Because a lot of what has been written about that is running ahead of the facts. No predictions, no tips, no products, just the machine. Start with the number itself. There is no such thing as a credit score, singular. FICO does not sell one score. It sells a product line. On FICO's own consumer site, there is a page that lays the versions out side by side. FICO Score 8 sits there as the version most widely used by lenders for things like credit cards and personal loans. Then there is a separate row for mortgages, and it does not say FICO 8. It says FICO Score 2 at Experian, FICO Score 4 at TransUnion, FICO Score 5 at Equifax. 3 different versions, one per credit bureau, for the single largest loan most households will ever take. The reason they all coexist is on the same page, in FICO's own words. Each lender determines if and when it will upgrade to the latest version. Some lenders make the upgrade quickly, while others may take longer. Meanwhile, the free score in a banking app is often a different animal entirely. Credit Karma, for example, shows a VantageScore 3.0 from TransUnion and Equifax. VantageScore is a different company's model. It runs on the same underlying files, but it is not a FICO score at all. So when the app says one number and the lender says another, nobody is lying. Those are 2 different instruments pointed at the same file. Now, which one counts? For a conventional mortgage, the kind that gets sold on to Fannie Mae or Freddie Mac, the lender does not pull one score. It pulls 3, one from each bureau, and then it applies a rule. Fannie Mae's selling guide states that rule in about as few words as it can. When 3 scores come back, choose the middle score. When only 2 come back, choose the lower score. The guide even spells out the ties. 700, 680, 680 gives you 680. 700, 700, 680 gives you 700. That structure has a consequence. The number that prices the loan is not an average. It is one bureau's opinion, selected by position. Which means if one bureau is missing an account, or is still carrying a collection that the other 2 have already dropped, that file is not just one voice out of 3. It can be the deciding one. And there is a separate rule again when there is a co-borrower, which works differently depending on whether the loan is underwritten by the automated system or by a person. We are not going to flatten that into one tidy line, because the guide itself does not. So we have arrived at a single number. Here is where it stops being a number and becomes a price. Fannie Mae publishes a document called the Loan Level Price Adjustment Matrix. The current version is dated the 28th of January, 2026. It is 9 pages long. Page 2 is the one to look at. Down the left side, credit score bands. Across the top, how much is being borrowed against the value of the house. In every cell, a percentage. Take the column for a loan between 75 and 80% of the value of the home. That is roughly the classic 20% down. Now walk down that column. 780 and above, 0.375%. 740 to 759, 0.875. 700 to 719, 1.375. 660 to 679, 1.875. And 639 and below, 2.75%. That column is the entire argument of this video. The score is not a compliment or a warning. It is a coordinate. It tells the table which cell to charge. The distance between the top row and the 660 band is 1.5 percentage points of the loan amount. On a $400,000 loan, that is $6,000. And I want to be exact about where that came from. I subtracted 2 cells on a public table and multiplied. It is not a dollar figure Fannie Mae publishes. The matrix also tells you how it works in its own language. All of these adjustments are calculated based on the acquisition date principal balance and are cumulative. Cumulative meaning they stack. The score cell is one of several. A condo adds another. An investment property adds a much larger one. And there is a line for the file that has nothing in it at all. Loans delivered without any credit score will be charged under the lowest credit score range shown in each of the applicable tables. No history, and the table reads you as its worst row. What we cannot hand you is a clean conversion from that percentage into an interest rate. There isn't one. A lender can collect the adjustment as money at closing, or work it into the rate instead, and that choice varies by lender. Anybody quoting you an exact rate difference per score band is estimating. So a product line of scores, a rule that picks the middle one, and a table that turns the middle one into a fee. That machine ran essentially unchanged for a very long time. Here's what moved. For decades, a loan sold to Fannie Mae or Freddie Mac required classic FICO, not a FICO score. That FICO score. On the 8th of July 2025, the director of the Federal Housing Finance Agency, Bill Pulte, announced that Fannie and Freddie would begin accepting VantageScore 4.0, effective immediately. Then, on the 22nd of April this year, the agency put the current shape on its own website. Approved lenders may, on an interim basis, choose between two approved credit score models, Classic FICO and VantageScore 4.0. The same page says the change does not alter the credit reporting requirement. 3 bureaus stays, 3 bureaus. On the 1st of July, Fannie and Freddie released historical data for a third model, FICO 10T, covering loan-level performance from April 2013 through September 2025. 12 years of it, so lenders and bond investors could test how that model would have called those loans. And on the 28th of July, FICO announced that more than 70 mortgage lenders had joined its 10T free access program, together representing $586 billion of annual originations and $1.865 trillion of loans being serviced. May and June were the program's two biggest months for signing lenders up. Now here is where a lot of the coverage is ahead of the facts, so let me be precise. FICO 10T is not yet the score that Fannie and Freddie take. The agency's own page says they expect to publish historical scores in the summer of 2026 and adopt scores from the model at a later date. Those 70-plus lenders are being handed 10T alongside classic FICO and no extra fee to compare against each other and to use on loans that never go to Fannie and Freddie at all. The adoption headline is real. The score on a conforming mortgage has not changed yet. What is actually different inside the new model is worth understanding because it changes what the number is measuring. A classic score reads a snapshot. One balance on one day as reported by the Bureau. FICO 10T reads up to 24 months of them, which means two people can be carrying the exact same balance against the exact same limit today and scored differently because one of them has been walking that balance down all year and the other has been walking it up. Same photograph, different film. None of that is a test of character and nobody is being caught out. It is a different question being asked. The old model asked, "Where are you?" The new one asks, "Where are you heading?" FICO says the payoff is that lenders can approve about 5% more mortgages at the same level of risk, or cut delinquencies by about 17% at the same approval rate. Those are FICO's numbers, about FICO's product, and FICO's own footnote calls them company estimates that may not match any particular lender's results. Worth knowing. Not the same thing as an independent finding. The second change is not about the math at all. It is about what is in the file to begin with. VantageScore 4.0 can use rent, utility, and telecom payments. That sounds enormous, and it can be, with one condition that almost never gets said out loud. Those payments only count if somebody actually reports them. A landlord is not required to. A utility is not required to. If nobody sends it, then as far as the model is concerned, 12 years of rent paid on time never happened. Then there is buy now, pay later. In June 2025, FICO introduced two scores built to read it, developed with a firm on a sample of more than 500,000 users. FICO's own write-up says 85% of buy now, pay later customers saw their score move by fewer than 10 points. And among heavy users with 5 or more accounts, 97% moved by fewer than 20. A firm reports its plans, including Pay in 4, to Experian and TransUnion. Klarna reports its longer monthly financing to TransUnion and keeps Pay in 4 off the file. And here's the detail that makes this whole thing rhyme. That data is on the report, and it is tagged, and the bureaus keep it out of the older scores. So for most lending decisions being made today, it is sitting in the file doing nothing at all. On the report is not the same as in the score. It is exactly the gap we opened with, one layer down. There is one more part of this machine that is easy to miss because it is not about any borrower. It is about what the number costs to buy. Over the last 5 years, FICO's wholesale royalty for a mortgage score went from 60 cents to $10. For 2026 alone, it doubled, from $4.95 to $10, for the same product as the year before. In March, Senator Josh Hawley wrote to FICO's chief executive to open an investigation into that pricing and wrote separately to the chairman of the Federal Trade Commission asking that agency to look as well. His office estimated the increase could add roughly $500 million to what the industry pays for mortgage credit scores. That is his office's estimate, not an audited number. FICO's own marketing says its scores are used by 90% of top U.S. lenders. Take that as what it is, the company's own figure, about the top of the market. But look at the shape of it, a score that lenders were required to use, sold by a company that had no competitor in that particular lane. Whatever anyone concludes about the price, that structure is what made the price possible. And that structure is the thing that changed first before any model did. Which brings us to the oldest question here. Why is there a score at all? Bill Fair and Earl Isaac founded their company in 1956. The first general-purpose credit bureau score arrived in 1989, built with Equifax. What came before it is the part we're sitting with. Into the 1960s, credit files carried character. Investigators gathered lifestyle information on people, including from their neighbors. The Congressional Record and the Law Review writing from that period described files noting drinking habits, morals, whether a couple was living together unmarried, and, in insurance reports, the tidiness of a man's yard. Some investigators simply invented the negative entries. The Fair Credit Reporting Act, pushed for years by Representative Leonore Sullivan and Senator William Proxmire, passed in 1970 in response to exactly that. So when a model turned up that only looked at whether the bills got paid, it arrived as the narrower instrument, the less personal one. That is the seat the score walked into, and I think it is worth remembering, because the argument now is not whether a machine should decide, it is which machine and who gets to pick it. One last piece of evidence, from the least dramatic document in America. The New York Fed publishes a quarterly report on household debt. The one released this week put total household debt at $18.8 trillion at the end of June, with $505 billion of new mortgages written in the quarter. And then, in a footnote on page 2, beginning in the first quarter of 2026, the credit score used in that report is the VantageScore 4.0. Previous reports used the Equifax Risk Score 3.0. The Federal Reserve Bank of New York changed which ruler it uses to describe American borrowers and mentioned it in a footnote. Not one person's file changed. The measurement did. And, for the week itself, Freddie Mac's survey on the 6th of August put the average 30-year fixed mortgage at 6.69%. Plenty of coverage called it the highest in more than a year. Freddie Mac's own number a year earlier was 6.63, which is lower. So the accurate version is the highest since the end of July 2025. We would rather say the smaller true thing. So back to the number on your phone. It is not a grade, and it was never a report card on how responsible anybody is. It is an input. It gets bought for $10, selected out of 3, dropped into a cell on the 9-page table, and turned into a percentage of the loan. And this year, for the first time in a very long time, there is a real argument about which model gets to fill that cell. None of this is hidden. It is just never in front of anyone at the moment it matters. That is a design choice somebody made, not something anybody failed to look up. Nobody sends a letter when the ruler changes. It shows up in a press release, a footnote, and a matrix dated the 28th of January. Now you know where to look. Educational only, not financial advice.